You buy a condo, furnish it, list it on Airbnb, and watch the bookings roll in while you keep your day job and let the passive income build. Now the real number. In September 2023, one single piece of city legislation wiped out 92% of Airbnb's listings in New York City overnight. And in November 2025, one of Airbnb's best-funded competitors, valued near $2 billion at its peak, filed to liquidate entirely within days of losing a single partnership. Here is what this actually costs. Start with the property itself. Buying a dedicated short-term rental investment property typically requires a down payment in the $75,000 to $180,000 range, depending on the market, before a single guest checks in. Furnishing that unit to a photo-ready, guest-acceptable standard runs $4,000 to $8,000 per bedroom, according to short-term rental operators who track this closely, meaning a modest two-bedroom unit alone can consume $10,000 to $20,000 in furniture, mattresses, and linens before decor is even considered. Add professional photography at $300 to $800. Listings without it consistently underperform in both views and bookings. Short-term rental permits and licensing that range from $50 to $2,500 depending on the city, and a standalone short-term rental insurance policy, since standard homeowners coverage typically excludes commercial guest days entirely. Set aside a 3-month operating reserve of $4,500 to $9,000 to cover the ramp-up period before bookings stabilize into a predictable pattern. All in, a realistic total for a single-owned, furnished short-term rental property lands between $85,000 and $220,000 before the first night is ever booked. Not the just list your spare room number most people picture when they imagine getting started. Every booking now carries Airbnb's host-only service fee, which the platform standardized at 15.5% of the total reservation value during its 2025 fee restructuring, a fee applied to the nightly rate, cleaning fee, and any add-ons combined. Standalone short-term rental insurance runs $80 to $250 a month per unit, covering gaps that Airbnb's own air cover program doesn't, including lost rental income during repairs, cleaning between guest turnovers, mortgage or rent on the unit itself, utilities running continuously regardless of occupancy, and property management software subscriptions to handle calendar syncing and guest messaging stack on top of that. Occupancy and hotel taxes vary by jurisdiction. New York City alone requires an 8.875% sales tax plus a 5.875% hotel occupancy tax on every short-term stay, taxes a host is personally responsible for collecting and remitting correctly. Annual permit renewals, photography refreshes, and furniture replacement as wear accumulates add a steady recurring drain. Add it together, and a single well-run unit is realistically carrying $25,000 to $40,000 a year in operating cost before a single dollar of net profit is counted, a number that exists whether the unit is booked solid every night or sitting empty through an entire slow month. Now the money side. Airbnb's own reported global average daily rate sits around $164 a night, and the average US occupancy rate runs close to 48%, according to industry-wide short-term rental data. Multiply that out across a year, $164 a night at 48% occupancy, and a single unit generates roughly $28,700 in gross booking revenue annually. Subtract Airbnb's 15.5% host fee, and gross revenue after the platform's cut drops to about $24,250. Subtract the $25,000 to $40,000 annual operating cost stack from Section 2, and for a large share of single-unit hosts, the year closes at break-even, or a loss before financing costs on the $85,000 plus entry investment are even factored into the picture. The math that looks like effortless passive income in a listing screenshot is, for a huge share of actual hosts, barely covering its own operating costs, let alone paying back the capital that got the unit furnished in the first place. That thin margin assumes stable local regulations and a stable platform fee. Neither of those assumptions has held, and the swings have already been large enough to erase entire markets overnight. The external variable is local short-term rental regulation, and New York City's Local Law 18 shows exactly how fast it can gut a market. Passed in January 2022 and fully enforced starting September 5, 2023, the law required every short-term rental host to register with the city, capped guest counts, and banned entire unit rentals under 30 days unless the host was physically present. Active listings in New York City collapsed from roughly 22,000 to about 3,200 within months of enforcement beginning, a 92% drop, with a $145 non-refundable registration fee and fines ranging from $1,000 to $7,500 per violation for hosts who kept operating without one, penalties steep enough to end a small host's entire operation over a single citation. By mid-2025, registered listings citywide sat at roughly 3,000, down from over 38,000 just 2 years earlier, a decline that held steady rather than recovering as hosts hoped it might. This wasn't a gradual market shift that gave operators time to adapt. It was a single piece of legislation that erased the majority of an entire city's host income in one enforcement date, and dozens of other cities have since studied New York's law as a model for their own regulations. To see what happens when that kind of instability meets a business that scaled aggressively on borrowed confidence, look at the company once called Airbnb's billion-dollar competitor. Sonder Holdings launched in 2014 with a pitch to merge hotel-level service with apartment-style short-term rentals, leasing, and renovating units across dozens of cities worldwide, and building a reputation as one of the most credible tech-forward challengers in hospitality. The company went public via a SPACs merger in January 2022, raising roughly $310 million at a valuation near $1.9 to $2.2 billion, and expanded to operate thousands of units globally across more than 40 countries. In 2024, Sonder struck a licensing partnership with Marriott International, branding many of its units Sonder by Marriott Bonvoy to gain access to Marriott's massive booking pipeline and hard-won brand credibility. That partnership became a single point of failure for the entire company, replacing years of diversified distribution with dependence on one hotel giant's willingness to keep the licensing deal alive. On November 7, 2025, Marriott terminated the licensing agreement, citing Sonder's default. 2 days later, Marriott announced the termination publicly and began emergency efforts to relocate stranded guests, some of whom received less than 24 hours' notice to vacate their units, with belongings left packed into garbage bags and stuffed in hallways. Sonder's interim CEO confirmed an immediate wind-down of operations, and the company filed for Chapter 7 liquidation in Delaware bankruptcy court, listing estimated assets and liabilities, each between $1 billion and $10 billion. Roughly 1,200 employees lost their jobs immediately, with no advance warning. Sonder's stock, which had briefly traded above $4 in early 2024, fell to roughly 9 cents to 20 cents a share, wiping out nearly the entire SPAC-era valuation. This was not a failure of hospitality concept or brand appeal. It was a capital-intensive real estate business run on tech startup cash burn assumptions, with less than 1/4 of cash runway relative to its fixed lease obligations, a structure that had no room left to absorb the loss of a single distribution partner. Here's a cost that changed dramatically and caught most hosts off guard: the platform fee itself. Through most of Airbnb's history, hosts paid a modest 3% fee, while guests paid a separate 14 to 16% service fee added at checkout. Starting in August 2025 and completed by December 2025, Airbnb replaced that split model entirely with a single host-only fee of 15.5%, meaning a host who didn't adjust pricing saw their effective commission jump roughly 5-fold overnight. Picture the transaction. A host who listed a room at $100 a night under the old model earned about $97 after the 3% fee, with guests separately paying an extra service charge on top at checkout. Under the new structure, that same $100 listing nets the host only about $84.50, unless the nightly rate is deliberately raised to compensate, and most hosts don't discover the gap until a full month of bookings has already cleared at the old, now unprofitable price, by which point the lost margin is already gone. There's another cost growing faster than any other line item in this business, and it isn't set by Airbnb at all. It's set by city councils, one ordinance at a time. That risk is regulatory enforcement, and it's escalating on two fronts at once: permit denial before a listing ever goes live, and after-the-fact penalties once it does. In New York City alone, the Mayor's Office of Special Enforcement approved only about 40% of registration applications submitted, denying over 4,300 for non-compliance, including more than 550 involving rent-regulated units that are barred from short-term rental use entirely under any circumstances. Hosts caught operating without an approved registration face fines of $1,000 to $7,500 per violation, and other major cities, including several actively citing New York's law as a template for their own ordinances, have moved towards similarly strict registration regimes since 2023. A single denied application or a single enforcement action against an unregistered listing can end a host's ability to operate that unit at all, not just reduce its profitability for a season the way a slow month would. Scale helps in specific ways. A multi-unit host or property manager spreads software subscriptions, professional photography, and cleaning team contracts across more listings, and a diversified portfolio across several cities isn't wiped out by one city's regulatory crackdown the way a single unit host in that city would be. But scale also means larger fixed lease and mortgage obligations that don't shrink when a booking platform changes its fee structure or a city changes its rules, and it means a single lost distribution partnership, exactly what happened to Sonder, can collapse an entire portfolio's cash flow at once rather than affecting one unit. At a certain size, short-term rental hosting stops being a side income stream and becomes a leveraged real estate operation entirely dependent on platform policy and municipal regulations staying stable at the same time, in every market at once, precisely the combination that gave Sonder no room to maneuver once one piece of that stability disappeared. Optimistic. A host buys and furnishes a single unit for $110,000 total, at $164 ADR and 55% occupancy, slightly above the national average. The unit generates $32,930 in gross bookings a year. After Airbnb's 15.5% fee, revenue is $27,826. Subtracting $28,000 in annual operating costs from Section 2 leaves a rough break-even, but strong occupancy pushes net profit to about $4,000 for the year. Thin, but positive. Realistic. Same unit, same host, same effort, same quality of listing photos and guest reviews. The city introduces a local law 18-style registration requirement mid-year, echoing New York's actual rollout, and the host's application is delayed for 3 months, while the unit sits idle, waiting on city approval, costing roughly $8,200 in lost bookings during that gap alone. Airbnb's 2025 fee restructuring catches the host mid-lease, before rates are adjusted to compensate, costing an extra $1,600 in the transition quarter before the pricing gets corrected, and a slow season, driven by nothing more than normal seasonal demand softness that every host in the market experiences, cuts occupancy from 55% to 45% for 1 quarter, costing another $2,900 in lost revenue. Recalculate, the $4,000 profit becomes a loss of roughly $8,700 on a property that was purchased, furnished, and operated exactly as planned from day one. The difference between those two scenarios is 1 registration delay, 1 fee transition, and 1 soft season. None of these are exotic disasters. All 3 happen to someone in this industry every year. According to AirDNA, the short-term rental data firm that tracks the industry most closely, roughly 35% of new Airbnb hosts quit or fail within their first year of operating a listing. The documented cause is rarely bad hospitality, poor communication, or negative guest reviews. It's structural, underestimated furnishing and financing costs going in, a platform fee structure that changed dramatically in 2025 with little individual notice, and local regulation that can eliminate a listing's legal status overnight, the way it did for 92% of New York City's market in a single enforcement date. 5 habits separate the hosts still profitable after year 1 from the ones who quit and sell the furniture at a loss. They register and secure local permits before listing, not after receiving a violation notice in the mail. They price in the full 15.5% host-only fee from day 1, rather than discovering the gap after a month of bookings has already cleared at the wrong rate. They carry dedicated short-term rental insurance instead of relying on Airbnb's built-in guest coverage alone, which was never designed to cover lost income during a forced closure. They diversify listings across more than one city or neighborhood where local rules genuinely allow it, so a single regulatory change doesn't end the entire operation overnight. And they hold a genuine 3 to 6 month cash reserve, rather than assuming occupancy will stay at launch week levels all year round. That condo you furnished and listed isn't really competing against other Airbnbs down the street. It's operating inside a system where a single city ordinance erased 92% of an entire market's listings in one enforcement date, and where a $2 billion competitor lost everything within days of losing one partner it had bet the whole operation on. The nightly rate was never the real risk in this business. The real risk is whether the rules and fees you built your numbers around are still the rules and fees by the time next year's booking calendar fills back in. Subscribe for the next breakdown in this series.